Welcome to Smart Finance Talks.
Ever feel like you're just lost in a financial maze, wishing you had a map that actually made sense?
Yeah, I think a lot of people feel that way.
You're definitely not alone. We're exploring the core ideas of finance.
Mm-hmm.
Think of this as your, express route to grasping how money really works in the world.
And for this journey, we've looked at a whole range of materials. Really interesting stuff, covering everything from, what money actually is, right down to the nitty-gritty of financial markets and institutions.
Exactly. Our goal today is simple. Pull out the most important principles, the fundamentals, and crucially show you how they all connect.
Right, see the bigger picture.
By the end, you should have a much clearer view of that whole financial landscape. Okay, let's jump in. Let's start with something we use every day, money itself.
It's funny, we use it all the time, but maybe don't think about its history much. It's a pretty fascinating story, really mirrors our economic development. Well, our sources trace it way back, starting with simple barter. Imagine trading your crops for tools, that kind of thing.
Right, direct exchange. Seems simple, but probably tricky.
Very tricky. Then you get commodity money emerging, things like gold, even livestock sometimes, serving as a common way to measure value. But the interesting thing is how unstable those early systems could be.
Yeah, like the value of your cows could fluctuate wildly, right?
Exactly. Imagine trying to buy a house with a herd of cows. So this is where gold started to become special.
Like gold.
It had its own value. You could make things with it, jewelry and such. But it also had this unique usefulness in trade. Marx actually pointed out that the very act of money circulating becomes its use value.
Okay, unpack that a bit. Marx is saying its main use is just moving around.
Basically, yeah. In a developed economy, its power isn't just that it's shiny metal, but that it constantly flows, making transactions happen. That constant movement is its key value, according to him.
Interesting. So from gold, where do we go? Paper.
Pretty much. We see the beginnings of paper money back in 17th century Amsterdam. Goldsmiths started giving out receipts for gold people deposited.
Ah, like an IOU for your gold.
Exactly. And those receipts started getting passed around as payment. Then this figure, Palmstruch, in Sweden, he took it a step further and started issuing paper money specifically for lending.
Bold move. Sounds a bit risky, though.
It was. Our sources suggest it was a classic case of, overdoing it. Too much paper money, not enough backing, caused instability.
So the bubble burst.
Pretty much. The king had to step in. And this whole episode, really, it led to the idea of chartered banks given the official right to issue banknotes, but under rules. A huge step.
Makes sense. And now, of course, we have electronic money, tapping our phones for everything.
Right, the latest evolution. But looking at that whole timeline, you see this constant theme. Humans refining how we exchange things. Money's history is the history of improving trade.
Okay, so it facilitates exchange, but it also measures value, right? Like a yardstick.
Precisely. And for money to measure value effectively, it needs to have value itself. That's where Marx's argument for gold comes in again.
So the theory is the value of a product comes from the labor needed to make it.
The socially necessary labor time, yeah.
Okay, and the price is just expressing that labor value in money terms.
That's the idea in that framework. And
Yeah.
then you have your monetary unit, dollars, dong, whatever, as the standard unit for those prices.
And as trade got bigger, crossing borders.
You needed something everyone could agree on, which led back to precious metals like gold and silver becoming the standard. Actually, early capitalism often used a bimetallic standard with both silver and gold.
Okay, fast forward a bit. What about systems like the Genoa system?
Right, in 1922, the Genoa system basically made the British pound the key global currency. It was a gold exchange standard, meaning other currencies were often pegged to the pound, which was itself linked to gold.
So London becomes the center of the financial world.
For a time, yes, it gave the UK a huge advantage. But, as our sources point out, it also made the pound and the British economy quite vulnerable if things went wrong. Holding the world's reserve currency has its downsides, too.
Always a trade-off.
Yeah.
Okay, let's shift gears slightly. Let's talk about something absolutely fundamental. The time value of money.
Ah, yes. Crucial concept. The simple idea that, a dollar today is worth more than a dollar tomorrow.
And not just because of inflation, right? It's about what you could do with that dollar today.
Exactly. It's the potential earning capacity. You could invest it, earn interest. That's why getting money sooner is better.
Which brings us to future value and simple versus compound interest.
Right. Simple interest is, simple. It's calculated only on the original amount, the principal.
Not the formula?
Yeah. FVN is PV0, 1 plus IN. FVN is future value. PV0 is a present value, or the initial amount. I is the interest rate per period, and N is the number of periods.
Straightforward. And
Yeah.
used mainly for short-term things.
Usually, yeah. Basic loans, simple savings accounts, it's easy to calculate, but compound interest, that's where the magic happens for long-term growth.
Because it builds on itself.
Exactly. Compound interest is calculated on the principal plus any interest that's already piled up. The formula is FVN equals PV01 plus IN. That little exponent n makes a huge difference over time.
So the borrower isn't just using the original loan amount. They're also using the interest that's been added.
That's the thinking. So the lender earns interest on the interest too. It really highlights how powerful time is in investing. Starting early makes a massive difference with compounding.
Yeah, that snowball effect.
Yeah.
Okay, great. Now, what determines how much money is actually out there? Supply and demand.
Pretty much. Let's start with supply, often explained using the money multiplier concept.
Okay.
First, you have the monetary base, MB, that's the physical currency out in circulation, call it C, plus the reserves banks hold, R. So MB is C plus R.
That's the core money from the central bank.
Essentially, yes. Then you have the broader money supply used for transactions, MS. That includes the currency C plus demand deposits, D money in checking accounts. So MSC plus D.
And the multiplier links these two. How did that work?
The multiplier shows how a change in the monetary base can lead to a bigger change in the overall money supply. The formula looks a bit scary. MCD plus 1. ERD plus RRD plus CD.
Whoa, okay, lots of ratios there, ER and RR.
ER is excess reserves banks hold above the minimum. RR is the required reserve ratio, the percentage of deposits banks must hold.
So what's the key takeaway from that complex formula?
The main thing is the inverse relationship with the required reserve ratio, RR. If the central bank makes banks hold more reserves,
They have less to lend out.
exactly. Less lending means fewer new deposits created, which shrinks the overall money supply relative to the base. So higher required reserves mean a smaller money multiplier effect. A small change by the central bank can ripple out.
Got it. So the central bank pulls levers to influence the supply. What about the demand side? Why do people want to hold money? Our sources mention Keynes.
Right. Keynes had his theory. He said, we hold money for three main reasons. Transactions every day buying and selling, precautionary motives having cash for emergencies, and speculative motives holding money hoping interest rates will change or asset prices will fall, creating buying opportunities.
And this demand depends on income and interest rates.
Largely, yes. Higher income means more transactions, so more demand. Higher interest rates make holding money less attractive compared to interest-bearing assets, so demand might fall. But Keynes also noted the velocity of money, how fast it changes hands, isn't stable. Meaning just looking at the amount of money doesn't perfectly predict economic activity because people's desire to hold on to it can shift.
So it's not just about how much money there is, but how quickly it's moving.
Exactly. Now, Friedman had a different take on money demand, didn't he?
Yeah, the quantity theory approach. He saw it more as an asset allocation decision. People choose between holding money and other assets, bonds, stocks, even physical goods.
And his point about goods and inflation is interesting.
Right. He argued that if inflation is higher than the return you get from holding money, people will prefer holding goods because their value is rising with inflation.
Makes sense. You want the thing that's holding its value better.
And Friedman really emphasized permanent income, didn't he?
He did. His function, MP, off your YP, suggests your long-term expected income is the main driver of how much real money balance MP you want to hold.
And he thought this demand was pretty stable.
Yeah, he argued it wasn't very sensitive to interest rate changes, partly because he thought returns on different assets tend to move together and because permanent income itself is relatively stable. This leads to a relatively stable and predictable money demand, and therefore a predictable velocity of money.
Okay, so different ways to think about why we hold money. That leads nicely into inflation. Always a hot topic.
Definitely. And again, different viewpoints. Classical economists often pointed to excessive money printing too much money, chasing too few goods.
Simple cause and effect?
In that view, yes. Samuelson had a broader definition, just a general rise in the overall price level.
But those views have limits.
They do. They don't easily explain things like cost-push inflation, where prices rise because production inputs get more expensive. And sometimes high inflation might not be directly caused by rapid money supply growth, though they often go together. Rising prices are the main symptom we see.
So what's a more encompassing definition?
Our sources define it as a situation where the amount of money circulating exceeds what's actually needed for transactions. This causes money to lose purchasing power, leading to a continuous increase in the prices of most goods. Basically, money supply outstrips the demand for money in circulation.
And we can categorize inflation in different ways, qualitatively and quantitatively.
Exactly. Qualitatively, you have balanced inflation prices and incomes rise roughly together, minimal negative impact. Then unbalanced inflation prices outpace incomes, which really hurts purchasing power. And expected inflation, a steady, predictable rate people can plan for.
Expected inflation sounds less disruptive.
It can be, especially in developing economies. If it's low and stable, like single digits, people adjust.
And quantitatively,
Yeah.
how do we measure it? The CPI.
The Consumer Price Index, yes, that's the most common measure. It tracks the average price change of a basket of typical consumer goods and services.
How do they pick the basket?
They figure out what typical households buy, assign weights based on importance in the budget, and then track the prices of those specific items over time, usually released monthly or quarterly.
But it's not perfect, is it?
No measurement is. Our sources highlight limitations. Like if beef gets expensive and people switch to chicken, the fixed CPI basket might not capture that substitution right away. Or quality improvements if a new phone costs more but is way better, how much of that price increase is really inflation?
Good points. So it's a useful snapshot, but not the whole story for everyone.
Exactly. Now, here's a counterintuitive idea. Sometimes a little bit of inflation can actually be good for the economy.
Really? How? Seems like rising prices are always bad.
Well, moderate, stable inflation can actually encourage spending and investment. Why hold cash if it's losing value slowly? It can stimulate production, maybe boost employment slightly. It also gives businesses some flexibility to adjust relative prices and wages subtly.
Okay, so a little grease for the economic wheels.
Kind of, but, and this is crucial, it needs careful management by the government to keep it moderate, because high inflation is definitely damaging.
Right, like galloping inflation or hyperinflation.
Exactly. Those are incredibly destructive. Rapid, uncontrolled price increases wreck business confidence, slash profits, lead to production cuts, rising unemployment, social unrest. They can cripple an economy and international trade.
Okay, so moderation is key. Let's broaden out again. What exactly is finance? It feels like more than just money.
It absolutely is. Definitions vary. One view describes finance as dealing with capital in its monetary form, how that capital moves through markets, institutions, organizations.
Like the plumbing of the economy.
In a way. A simpler view is just providing and spending funds, whatever the source. But a broader understanding, like from Investopedia, sees it as both an art and a science.
Art and science.
Yeah, using tools like statistics and math, but also requiring judgment, research, business acumen. It covers managing money, credit, banking, investments, assets, the whole spectrum.
And a key aspect is distribution.
Yes, the distributive function is central. Finance is fundamentally about how monetary funds are gathered and then allocated or used. The key is that it involves distributing value in monetary form. Just moving money around without that value allocation isn't really finance in this sense.
So it's about directing economic value using money as the tool.
Yeah.
What are the main jobs or functions of finance?
Our sources list 4 key ones. Mobilizing capital gathering funds, allocating capital, deciding where it goes, supervising or controlling its use, and creating motivation incentives for using capital effectively. And they all work together.
Who's typically in charge of this? A CFO.
Often, yes. A chief financial officer or financial director plays this role in businesses. But the same functions exist in government budget planning, managing major projects, even in managing household finances, really. It's about managing the life cycle of funds formation, distribution, use.
And that distribution part is foundational.
Absolutely. It's the prerequisite for the other functions. It's also how governments can indirectly steer the economy, creating a stable environment for growth.
But it only works well if certain things are in place.
Right. You need rational financial management mechanisms, an efficient state financial system, management governed by law, and capable financial managers. Without these, the system breaks down.
And finance is a tool for managing the whole economy.
Definitely. It guides the flow of capital from those with a surplus savers to those with a deficit borrowers or investors.
Like households saving money, which then gets loaned out for mortgages.
Exactly. Or a company with spare cash investing in a growing startup. This can happen directly, like buying stock, or indirectly through financial intermediaries.
Banks, credit unions, investment funds.
Precisely. They mobilize savings through various instruments, deposits, bonds, etc. And household finance itself is a huge source of capital, especially in developed economies, and increasingly important everywhere. It shapes saving and consumption patterns.
So how households manage their money matters for the whole economy.
Very much so. It's about allocating their resources, current and future, to meet their needs now and later. How they do that depends on jobs, education, personal habits. It sets their financial priorities.
We can also categorize finance based on purpose and ownership.
Yes. First, by purpose. Public finance is for public benefit, tied to government activities, think defense, roads, things the private sector might not provide efficiently. Private finance is for private benefit businesses, banks, insurance, households, social organizations, both grow in market economies.
And by ownership.
State finance uses funds owned by the government. It plays a big regulatory role, fixing market failures, creating a good environment for all sectors, including private ones. Non-state finance uses funds owned by the non-government sector, private businesses, individuals, NGOs, etc., supporting their own activities.
Okay, that clarifies the different spheres. What about the international dimension? International finance.
That covers the financial relationships arising from all sorts of interactions between countries' economic, cultural, social. It needs money that functions globally as world money.
And it's driven by countries specializing in different things.
Largely, yes. International cooperation stems from the International Division of Labor countries focusing on what they do best, driven by their own development needs.
And how does a nation's public finance system fit into this international picture?
It's the bedrock. Public finance is funded by the whole economy to serve broad social needs guaranteed by the state. Its role is shaped by its functions, government leadership, and how it influences and regulates the financial activities of everyone else in the economy.
And capital flowing between countries is a big part of this. FDI, loans.
Huge part. Foreign direct investment, portfolio investment, loans, aid. These flows are often driven by differences in investment efficiency between countries where capital can get the best return, basically measured by things like the marginal efficiency of investment, or IQR.
ITOR.
Incremental capital output ratio. It roughly measures how much investment you need for one extra unit of output. Capital tends to flow where that ratio is lower, meaning investment is more productive.
Makes sense. Let's zoom back in on public finance. How does the government actually get its revenue?
Several factors influence state budget revenue. Economic growth rate is key, obviously. The structure of the economy matters. How national income is distributed, tax policies, natural resource wealth, especially for developing countries, and how connected the country is globally.
Are there constraints?
Oh, definitely. Things like low average income or rising wage costs can limit how much revenue a government can realistically collect, as noted for your country, listener.
And taxes are the main tool. How are rates set?
Tax rates are the amount payable per unit of the tax base. They can be absolute, a fixed amount, like on a specific import, or proportional, usually a percentage. Proportional rates can be fixed percentages or progressive, meaning the rate increases as the tax amount increases.
And on the spending side, how is that categorized?
Common categories include economic affairs, social cultural things, government administration, defense and security, and other consumption. This helps analyze spending outcomes relative to GDP and balance national saving versus consumption.
Any downsides to that classification?
Well, it might not clearly show how spending links to specific government functions, making it harder to optimize allocation over time. Now, about deficits.
Right. Governments often spend more than they take in. Is that always bad?
Not necessarily. Moderate deficits, say under 5% of total spending, can actually stimulate production in a market economy. A key principle, though, is distinguishing between regular income, like taxes, and spending on long-term economic investments.
And if there is a deficit, how do governments cover it?
The main ways are raising taxes or other revenues, cutting spending, or borrowing money. Printing money is also an option, but carries significant inflation risks, as we discussed.
What about those off-budget funds you mentioned?
Right, off-budget state financial funds. These are set up for specific purposes, allowing targeted government intervention in the economy, but still under state control. The government decides how they're used. Their size, like the main budget, depends on the overall economy.
And the state also acts through credit, borrowing and lending.
Yes, state credit. The government borrows to finance deficits and invest in key sectors. It might also guarantee capital for state-owned enterprises, SOEs. Profitable SOEs, especially vital ones, often get priority state investment and, in turn, pay taxes and fees back to the budget.
Okay, comprehensive look at public finance. Let's switch to the private side. Corporate finance.
Yeah.
Managing a business's money.
That's the core of it, yes. Managing the capital of a business, balancing the demand for capital with the supply, all to achieve the business's objectives.
And those objectives need to be clear, right? Short-term versus long-term.
Absolutely crucial. What's the goal now versus down the road? A very common goal is profit maximization.
Makes sense. Businesses need profit to survive.
They do. It aligns with the basic idea of covering costs and making money. But focusing only on profit has pitfalls.
Such as?
Potential for dodgy accounting to boost numbers, neglecting long-term strategy for short-term gains, prioritizing profit over actual cash flow, even cutting corners or breaking laws.
Well, what's a better, broader goal?
Maximizing the value of the firm is often seen as more comprehensive. It considers long-term benefits, incorporates risk, factors in the time value of money. The ultimate aim is increasing shareholder wealth and the company's overall prestige and sustainability.
A more holistic view. Now, the capital businesses use, what exactly is it?
Business capital is basically the monetary value of all the assets a business uses to operate.
And it has specific characteristics.
Yes. It's essential for starting and running the business. It reflects ownership and usage rights. It's constantly circulating and changing form during operations. And crucially, using capital always has a cost interest on loans, opportunity cost of equity.
How is it typically categorized?
Several ways. By origin, equity, owner's money versus borrowed capital. By duration, fixed capital, long-term assets versus working capital, short-term needs. By function, capital used in production versus capital used in circulation or sales.
Let's talk working capital, the short-term stuff.
Exactly. It's the value tied up in current assets needed for each production or sales cycle. Think inventory, cash for payroll. Its value gets built into the product cost and is recovered when the product is sold. It's the operational lifeblood.
Contrasted with fixed assets, the long-term investments.
Right. Machinery, buildings, equipment, things used repeatedly over many cycles. They keep their physical form but lose value over time.
Through depreciation.
Precisely. Depreciation allocates the cost of that fixed asset over its useful life, reflecting wear and tear and obsolescence. It's vital for accurate cost calculation, valuing the business, and making investment decisions. There are different methods, straight-line, accelerated, units of production.
But the goal is matching the asset's cost to the period's benefits.
Exactly. And fixed capital is just the monetary value represented by those fixed assets. Its value transfers gradually to products over time and is recovered through sales, hopefully funding replacement or new investment.
Okay, back to working capital. What are its main components?
Typically, cash on hand, short-term investments, accounts receivable, money owed by customers, inventories, raw materials, work in progress, finished goods, and sometimes prepaid expenses that are allocated over time. Basically, assets expected to be converted to cash within about a year.
Where does all this business capital come from?
Several sources. Equity capital is the foundation owner's investment, profits kept in the business, retained earnings. Then there's borrowed capital, short-term, like trade credit or bank overdrafts, and long-term, like bank loans, bonds, or financial leases.
Any of those sources.
Supplementary capital can come from reinvesting profits specifically. And in joint ventures, capital comes from the partner's contributions, which could be cash or assets like equipment or property.
So a mix of internal funds, owner funds, and external borrowing. Now, using this capital aims for profit, but involves risk. Let's unpack that.
Profit is the bottom line for many revenue minus the cost to generate that revenue. It's a key performance indicator.
And it serves multiple functions.
Yes. It's an objective, a motivator, and a condition for survival. Consistent losses mean bankruptcy eventually. It's also a comprehensive indicator reflecting how well all parts of the business are working together.
But the path to profit isn't smooth. There's risk.
Always. Business risk is the potential for losses or lower than expected profits due to various factors, internal or external.
How are risks categorized?
Often into systematic or market risk and non-systematic or specific risk. Systematic risk affects the whole market. Think interest rate changes, recessions, inflation. You can't diversify it away easily.
And non-systematic.
That affects just a specific company or industry. This includes business risk uncertainty in earnings due to the nature of the company's operations, market shifts, competition, management errors, and financial risk.
Financial risk is tied to debt.
Primarily, yes. It's the extra risk a company takes on when it uses borrowed money. More debt means higher fixed interest payments, increasing vulnerability if earnings falter.
So corporate finance is this constant balancing act between pursuing profit and managing these different types of risk. Let's move to credit and banking, how capital actually moves.
Right. Credit is fundamental. It's transferring the right to use capital for a specific time for a fee interest. It bridges the gap between wanting to spend or invest now and having the funds later. The interest rate is the price for that bridge.
And there are different forms of credit. Commercial credit.
That's credit between businesses. Usually when one sells goods to another on deferred payment terms, buy now, pay later, it's different from bank credit. Businesses need to weigh the benefit of getting goods early against the implicit cost.
Then there's bank credit.
Provided by banks and other credit institutions to individuals, households, businesses, usually in monetary form. It's vital for capital circulation and growth. But mismatches can happen sometimes, credit demand surges, but production lags or vice versa. That's just part of the economic cycle.
And banks use credit money.
Yes, the instruments like loans circulate. Lenders might get promissory notes or CDs, borrowers sign contracts. Then there's state credit.
The government as borrower and lender.
Exactly. It depends on the creditworthiness of the state. The government borrows to cover deficits or fund development, often issuing bonds. Careful planning and efficient use are key for repayment. It blends credit principles with fiscal and monetary policy. The state also lends, often preferential loans.
And government bonds are the main instrument.
Yes, like treasury bills for short-term needs, which the central bank also uses for monetary policy.
What about financial leasing? Is that a form of credit?
It's considered a form of medium to long-term credit. The lessor, like a finance company, owns an asset and lets the lessee, a business, use it for periodic payments. Key differences from just renting depend on ownership transfer, risk handling, and lease duration versus asset life.
How is it defined formally?
Accounting standards look for things like, does ownership transfer at the end? Can the lessee buy it cheap? Does the lease cover most of the asset's economic life? Do the payments essentially cover the asset's fair value? If yes to criteria like these, it's usually a financial lease.
What are the advantages for the business using the asset?
Less upfront cash needed, offer flexible payment terms, potential tax benefits, and the lessee avoids the risk of the asset becoming obsolete quickly. It's very common, especially for equipment.
Are there specific types?
Yes, things like leaseback, sell an asset you own, and lease it back to free up cash. Leveraged leases for very expensive assets where the lessor borrows a chunk of the cost, and under leases where the original lessee sublets the asset.
Interesting options. Now, interest rates the price of credit. What drives them?
It's the interception of supply and demand for loanable funds. Plus, inflation expectations, perceived risk, government policies, especially central bank actions, and even global factors. It reflects the opportunity cost of capital.
And they influence individual behavior, saving versus spending.
Big time. Higher rates generally make saving more attractive and borrowing spending less so. And always distinguish nominal rates, the stated percentage, from real rates, which adjust for inflation to show the true change in purchasing power.
What about rates in different markets? Commercial credit rates.
Those are often embedded in the price of goods sold on credit between firms. They depend on the payment period, supply demand for that specific trade credit, and trust. Usually not explicitly stated like a loan percentage.
And rates in the interbank market.
That reflects banks' short-term liquidity needs and is heavily influenced by central bank policy tools like the discount rate or refinancing rate directly impact what banks charge each other overnight.
Does changing the money supply affect rates?
In the short term, increasing the money supply generally pushes interest rates down. Long-term effects are more complex, involving impacts on income, price levels, and inflation expectations.
What are the overall roles of credit interest rates in the economy?
Key roles include encouraging savings by offering a return, allocating capital towards potentially profitable investments, higher expected profit justifies paying higher interest, and acting as a tool for macroeconomic control, especially influencing inflation.
Okay. Now, shifting to safety nets.
Yeah.
Deposit insurance and social insurance.
Yes, important protections. Deposit insurance protects depositors if their bank fails, which boosts confidence and stability in the whole banking system. Vietnam's Deposit Insurance Organization is an example.
And social insurance, like BHXH in Vietnam.
That's compulsory insurance for many workers designed to provide financial support during illness, maternity, disability, retirement, or after death. Funded by contributions from employees and employers.
Where do those funds go?
Payments for sickness, maternity benefits, work accident compensation, retirement pensions, survivor benefits, unemployment support, healthcare premiums for retirees, contributions to primary healthcare, plus contingency funds and admin costs.
Okay. What about co-insurance and reinsurance? How do insurance companies manage their risks?
Good question. Co-insurance is when multiple insurers share the risk on a single policy, like for a huge building. Each takes a percentage of the risk and gets that percentage of the premium. It lets them cover risks too big for one company.
And reinsurance.
That's insurance for insurance companies. The original insurer, the ceding company, pays a premium to transfer part of its risk portfolio to another company, the reinsurer. This protects the original insurer from massive claims and smooths out the results.
So insurers spread their own risk around too. Let's talk about where a lot of this happens. Financial markets.
Financial markets are essential to market economies. They're the arenas where the demand for capital meets the supply, bringing together businesses, governments, households for investment, capital formation, consumption.
And they're structured, right? Money market versus capital market.
Exactly. The money market deals in short-term debt instruments, maturity under a year, usually high liquidity, lower risk. Think treasury bills, commercial paper, CDs. Key players are banks, the central bank, big corporations. The capital market deals with longer-term instruments, maturity over a year, generally higher risk. Stocks and bonds are the main examples here. Participants include investors, issuers, companies, government, and various intermediaries.
And within these, primary versus secondary markets.
Crucial distinction. The primary market is where new securities are issued and sold for the first time, like an IPO. The secondary market is where existing securities are traded between investors.
Why is the secondary market so important?
It provides liquidity, the ability to easily buy or sell existing securities. It also helps with price discovery, figuring out what securities are worth. This makes investors more willing to buy in the primary market in the first place.
What are the overall functions of financial markets?
Key functions include channeling funds from savers to borrowers, investors, reducing transaction costs by centralizing trading and information, helping stabilize money circulation, providing liquidity for financial assets, and allowing for risk diversification.
So they play a vital role in making the economy work efficiently.
Absolutely. They mobilize capital for development, improve how capital is allocated, facilitate international capital flows, promote investment through securities trading, and enhance the overall transparency and efficiency of the financial system.
Let's list some specific money market instruments again.
Okay. Treasury bills, T-bills, negotiable certificates of deposit, CDs, commercial paper, repurchase agreements, repos, bankers' acceptances, BAs.
And the main players active in that short-term market.
The state treasury, borrowing short-term. The central bank, conducting monetary policy via open market operations, often using T-bills. Commercial banks, issuing CDs, BAs, lending, borrowing. Large corporations issuing commercial paper, plus investors, brokers, dealers. The T-bill market is often the largest segment.
Now for the capital market longer term. Instruments.
Stocks, common and preferred, bonds, government, municipal, corporate, and derivatives like options and futures.
The stock market is where ownership shares trade. Where does this happen?
It can be on organized exchanges, formal marketplaces with listing rules like HOSE or HNX in Vietnam or the NYSE in the US, or it can be over-the-counter, OTC, a less formal network for unlisted or less traded securities. And of course, much trading is electronic now.
And bonds are debt, essentially IOUs from the issuer.
Correct. Issuer promises to repay principal plus interest over time. Government bonds are usually lowest risk, then municipal bonds from local governments, then corporate bonds with varying risk levels.
Derivatives are more complex, value based on something else.
Exactly. Their value derives from an underlying asset, stock, bond, commodity, currency. Forwards are custom agreements to trade later. Futures are standardized forwards traded on exchanges. Options give the right, not obligation, to buy, call, or sell put at a set price by a set date for a premium.
Who are the key players in the stock market specifically?
You have issuers, corporations raising funds, investors, individuals and institutions like banks, securities firms, investment companies, insurance firms, mutual funds, pension funds, securities companies, brokers, dealers, underwriters, advisors, commercial banks, investing within limits, sometimes underwriting via subsidiaries rules, vary globally, stock exchanges themselves, clearing and settlement organizations, and IT infrastructure providers.
That structure for banks doing securities business varies, right? Universal versus separate.
Yes, the universal banking model, like in Germany, allows banks to do both commercial banking and securities business directly. The separate model, historically U.S. post-Glass-Steagall, though that's changed, kept them more distinct.
Okay, complex ecosystem. Let's talk about the institution at the top, the central bank.
Central banks have evolved hugely, started mainly as currency issuers and government bankers. Now their core roles are managing monetary policy and ensuring financial stability for the whole country.
Why are they necessary in a market economy?
They provide a stable currency, oversee banking and credit activities, and act as a lender of last resort and banker to the commercial banks. This creates that two-tier system. Central bank overseeing intermediary commercial banks. They've become increasingly sophisticated over the centuries.
How are they typically set up?
Usually a board of governors, a governor or president leading it, and specialized departments for different functions like research, policy implementation, supervision. Independence is a key theme.
Right. Central bank independence. Different models exist.
Yes. One model has the central bank accountable to the legislature, but independent of the government's executive branch. The U.S. Federal Reserve is the prime example. We see its structure with the board, FOMC, 12 regional banks, and its tools like reserve requirements, discount rate, open market operations. The other main model has the central bank subordinate to the government, like the People's Bank of China. Appointments and directives come more directly from the government, State Council, National People's Congress. It operates more under direct government guidance.
What about development banks?
Those are usually state-owned or majority state-owned, operating nonprofit to fund specific national development goals, often providing medium to long-term finance for key sectors, typically with fewer branches than commercial banks.
Okay. Beyond central banks and commercial banks, we have non-bank financial institutions. What falls into this category?
The broad term credit institution, TCTD, covers any business doing regular banking operations, deposits, credit, payments. This includes commercial banks, NHTM, but also non-bank credit institutions, microfinance organizations, and people's credit funds.
So what makes a non-bank credit institution different from a commercial bank?
Non-bank financial institutions, TCTC, PNH, perform some banking operations, but crucially, they typically don't take deposits from the general public or provide payment services through customer accounts in the same way banks do. Think financial companies, leasing companies, investment funds.
Investment funds, like mutual funds, are a big example.
Yes. Collective investment funds pool money from many investors. Because shares are often widely held by small, non-professional investors, they face strict regulations to protect those investors.
How are they categorized?
By what they invest in stock funds, growth versus income focus, various bond funds, government, global, corporate, etc., or by structure open-end funds, mutual funds, constantly issue and redeem shares at net asset value, offering easy entry-exit.
And pension funds. Also major players.
Hugely important, especially in developed countries. They manage retirement savings, providing income security, but also channeling vast amounts of capital into financial markets. Can be private, company plans, or public social security systems.
Public systems are facing challenges, though.
Often, yes. Aging populations mean fewer workers supporting more retirees. This leads to discussions about reforms, like adjusting benefits, raising retirement ages, or changing investment strategies.
Okay, diverse financial landscape. Let's wrap up by revisiting the main policy levers: monetary and fiscal policy.
Right. The big tools for macroeconomic management. Economic policy broadly is about the government's overall approach, views, goals, tools, structures to influence the economy and society.
Fiscal policy is specifically about government spending and taxes.
Exactly. The government uses its budget spending levels and tax rates to influence aggregate demand, output, employment, and inflation.
And monetary policy is the central bank's domain.
Yes, actions taken by the central bank to manage the money supply and credit conditions, aiming to stimulate or restrain economic activity to achieve goals like price stability and full employment.
We mentioned the long-run Phillips curve earlier, suggesting no long-term trade-off between inflation and unemployment.
Correct. In the long run, the idea is unemployment tends towards its natural rate, regardless of the steady inflation rate. This influences how central banks think about their goals. They often use intermediate targets for policy.
Because the final goals are hard to hit directly and quickly.
Precisely. Policy effects have lags. So they might target something they can influence more directly and quickly, hoping it will lead to the desired outcome later. Common intermediate targets are measures of the money supply, like M1 or M2, or market interest rates.
Can they target both at once?
Usually not effectively. They often have to prioritize one or the other. Sometimes exchange rates or credit growth are used as intermediate targets too, especially in certain economies.
And the tools the central bank uses to hit these targets.
The main ones are reserve requirements, percentage of deposits banks must hold, the discount rate or refinancing rate, interest rate for banks borrowing from the central bank, and open market operations, buying, selling government securities. OMOs are the most frequently used and flexible.
And fiscal policy's impact, spending and taxes.
Government spending directly impacts aggregate demand. Taxes affect disposable income and thus consumption and investment. But its effectiveness depends on aggregate supply, too. Too much stimulus can cause inflation, raise interest rates, crowding out private investment, limiting the net effect.
Wow, okay. We have really covered a massive amount of ground today, from the absolute basics of what money is, all the way to global finance and policy tools.
We certainly have. We've journeyed through money's evolution, the power of time and interest, supply and demand dynamics, the complexities of inflation, the definition and functions of finance itself, how financial markets and institutions work, and the roles of monetary and fiscal policy. It's all interconnected.
Absolutely. And hopefully, listener, understanding these core concepts gives you a much more solid foundation for, navigating the financial news, making sense of trends, maybe even managing your own finances better.
That's the goal. Having that framework helps demystify a lot of it.
Definitely. So, as a final thought to leave you with, think about how fast finance is changing. Digital currencies, fintech, AI, and trading. How might these innovations challenge or maybe even reinforce the fundamental principles we've talked about today?
Good question. Will the core ideas of value, time, risk, and intermediation still hold, just in new forms, or will something fundamentally shift?
Something to ponder. Maybe a topic for a future deep dive. Thanks for joining us.